Hi everyone. Today we're taking a look at an alternate version of exercise 7-7. Let's take a look at the problem. It says daily company estimates uncollectible accounts using the allowance method at December 31st. It prepared the following aging of account receivables. Its analysis of account receivables shows that they have total account receivables as of December 31st of $700,000. Now that's broken up into several amounts. An amount that is currently not past due of $400,000, an amount that is between 1 and 30 days past due of $150,000, 31 to 60 days past due of $80,000, 61 to 90 of $40,000, and over 90 of $20,000. Now we're going to try to prepare for this an estimated of the accounts that cannot be collected using this aging method. One thing we know from logic is that the longer somebody becomes past due, the less likely that they will pay what is owed. We see this represented by the percent amounts. The longer that these accounts get past due, the more of that the company thinks they will not be able to collect. That's typically based on historical experience or industry information. So what Daly has done is they're going to take each of these percents times those amounts and come up with, for that aged amount, how much they think they will not be able to collect. So we're asked to calculate the estimated balance of the allowance for doubtful accounts using the aging method, and that's going to be the account receivable times that percent uncollectible. So for the not yet due of 410 times 1%, they estimate of that total amount that 4,100 will not be able to be collected. For the next aging group of 150,000, 3%, 4,500 not collected. The next one, 80,000 at 4%, 3,200. The next one, 40,000 at 6%, 2,400. And finally, for the over 90 days past due of 20,000, 10% of that they estimate will not be able to be collected, or $2,000. Total that up, and we have an estimated balance of allowance for uncollectible accounts of $16,200. So what this means is out of the $700,000 that they have due, they don't think they'll be able to collect $16,200 of that. So we're going to have to determine what is the amount of bad debt expense. First off, we need to know that out of the $700,000, they want to have the adjusted ending allowance of $16,200. If there happens to be a beginning credit balance, we'll take the difference between the credit balance and the targeted adjusted amount and plug that. The same thing would do as a debit balance. If there was a debit balance in the allowance account, we take the difference between that debit balance and the adjusted allowance amount on the credit side and make a plug for that. The plug either way will become our bad debt expense. So prepare the adjusted entry to record bad debts using the estimate from Part A. Assume the unadjusted balance has an allowance for doubtful accounts of a credit of $1,200. So we know that it has a $1,200 credit. We know that we want the amount to be $16,200 at the end. So what's it take to go from a credit of $1,200 to a credit of $16,200? Well, that's going to require an adjusted entry of $15,000. So the adjustment will be made to the allowance account of $15,000. That amount will also become our bad debt expense for the period as well. So the bad debts go from 0 to 15,000, and our allowance for doubtful accounts go from 1,200 to 16,200, our target amount from the aging analysis. On the balance sheet, we'll see the account receivables less that amount that we calculated from the aging analysis to give us the balance of receivables that would be reported of $683,800. Finally, it says prepare the adjusted entry to record bad debt expense using the estimate from Part A if instead the allowance in the account was a $500 debit. Well, in this case, we're going to have a $500 debit rather than the credit. We still have that $16,200 target amount. So what's it take to go from a $500 debit to a $16,200 credit? The answer will be an adjustment of $16,700. So the $16,700 will then become our bad debt expense, and the allowance account gets an adjustment of $16,700. On the balance sheet, we show the $700,000 still. We show our target from the aging of 16.2, and we still show the exact same amount of the account receivables. Regardless of what is the debit or the credit balance in the allowance account, we always want to have a final ending adjustment of the amount we came up per the aging. That will then require the plug to balance that out. So bad debt expense still stays 16.7. Sorry about that. And that is the conclusion of this demonstration on the problem.